I am both an advisor and the president of ClearStep Financial. I am here to welcome you to today's economic and market update presentation and introduce you to our speaker. Our goal at ClearStep Financial is to educate and teach about money and finance through the ever-changing world. How many of you think our world is changing? Raise your hand. How many of you think it's not? To help us accomplish this goal today, I am pleased to introduce you to our guest speaker, Andrew Opdyke of First Trust Advisors. Andrew is a senior economist and a member of the First Trust economics team that Bloomberg has ranked as one of the top forecasters of the U.S. economy over the past several years. At First Trust, Andrew is responsible for analyzing economic indicators, writing economic commentaries, and producing articles on the First Trust Economics blog. Andrew also provides research and analysis to Chief Economist Brian Westbury, Chief Market Strategist Bob Carey, and First Trust CEO Jim Bowen. Considering Andrew's background and in light of the current market activity, we believe Andrew's presentation will be timely and informative. Also, please wait at the end. If you do have questions, please put them in the chat. And at the end, I will read off the questions and Andrew will be able to answer questions at the end of the presentation. And we thank you, Andrew, for taking part in this important presentation today. Thank you.
Yeah, Carla, thank you so much. And thank you, everybody, for joining us. It has been quite the year so far. We've had plenty of volatility. We've had more volatility in the markets and in the economy, the day-to-day of what's coming out of Washington than we do in our amazing Midwestern weather where we get snow one day and 70 the next. And it's interesting because it feels like some things that we're watching are turning day to day in similarly kind of incredible fashion. There's a number of things we're going to talk about today. I'm going to bring a couple slides. And what I want to do is I want to work from the short term, what we're hearing about today, what I'm hearing a lot of questions on right now, and work our way towards what we're likely to hear as we progress through the year. And I really want to end by looking at what drives us, the economy, the market, global growth, prosperity over time. And I love that we're having this conversation today, right now. In fact, right as we kicked off this meeting, the Federal Reserve released their statement. They meet every 6 to 8 weeks to talk about, are they going to move interest rates, cut, raise? What do they see on inflation? What do they see on growth? They didn't make any changes to their outlook today. They kept rates where they were. And quite frankly, they said, hey, we are getting a lot of questions. As the Federal Reserve, we're analyzing what's going to happen with tariffs, what's going to happen with political change, potential tax cuts coming later in the year, changes with regulation, deportations, and things like that. And they said, we're not doing anything today. And quite frankly, we haven't really substantively shifted our view on this year. Now, that may be surprising to some people because when you turn on the TV, they're talking constantly about how dramatic the changes are from things like tariffs. And tariffs, as an economist, they're an interesting thing to deal with because a lot of what gets talked about and what we see in actual implementation can be quite different. Now, what I'm showing on the screen right now is the US and our 10 largest trading partners. This is something you're going to hear talked about a lot as we get into the beginning of April. They've talked about doing what are called reciprocal tariffs. Essentially, what that is saying is here we are, the US, and this data comes from the World Trade Organization. The World Trade Organization shows that we have a lower tariff rate than any of the other 10 countries that we do our most business with. Now, tariffs so far this year have come up in a few sources. It's going to be broadening out potentially as we move into April. It started the year with Canada and Mexico and China. And I'll tell you, China was going to get tariffs no matter what. That did not matter whether this was the Trump administration, the Harris administration. They got included during the Biden administration and Trump 1.0. There's been this ongoing we'll call it a bit of a conflict with China. I think they had a misunderstanding of the word copyright. They thought it meant the right to copy. It was a translation issue, I'm sure. But we've had this ongoing disagreement with China saying, hey, we need you to respect intellectual property rights, trademarks. We can't have you just copying technology that comes out of the US and then selling it as your own as a new company. That we've got some issues there. So China, we saw some escalation. Canada and Mexico was one that I think a lot of the world was watching and saying, what's going to happen here? These are right now our two largest trading partners. Now, again, you look at these rates and you say, okay, Canada and Mexico, they're charging higher rates than the US charges. And they have, to be honest, they have a heavy reliance on the United States. When you look at Canada and Mexico and what they sell to the United States, for each one of those two countries, of everything that leaves their borders gets sold to another country, 74% plus. So roughly three-quarters of everything they produce and send outside ends up coming to the United States. Now, they're a smaller portion of our imports, and there was some discussion on can we get help at the borders, whatnot. But I also I want to bring up early what I call the 72-hour. Okay, when you hear Trump say something, whether you love him, you hate him, there's not too many people that seem to be in between. Regardless of how you feel about him, when he says something, wait 72 hours and see if he does something. Because this can quite frankly save a lot of headaches. Think back to when we originally heard that tariffs were going in on Canada and Mexico. So this is going back to the beginning of February. And there was an announcement, 25% tariffs. These went into place. The market started seeing volatility. That Monday morning, I got on a plane. I was flying to New York for meetings. I got on the plane at O'Hare International Airport. We had tariffs in place on Canada and Mexico. I took an hour and 58-minute flight. And as I landed, I found out we no longer had tariffs on Canada and Mexico, right? It was about a 2 hour time period where that completely changed. Now it got pushed back for a month. A month later, the tariffs are coming back on, and we hear on the news and they're talking about the impacts that it's going to have on Canada, Mexico, the US economy. That morning I got on a flight to California. I got on the flight. We had tariffs on Canada and Mexico. Took that 4 hour flight, got off. We no longer had tariffs on Canada and Mexico. Then we started seeing discussions on escalation in other areas. And I swear, every time I get on a flight, policy seems to change. So if you got a policy you don't like, let me know. I'll go fly somewhere and we'll turn that around. But one of the big takeaways is Trump has this tendency to escalate to negotiate. He brings the heat early and he kind of brings a lot of emphasis. And ultimately, that leads to faster negotiations. It brings some hostilities with it. But a lot of these have tended to be relatively short lived, and we come to negotiations. Now, the reciprocal tariffs, you're going to see this broaden out and you're going to see a lot of discussions. What reciprocal tariffs are saying is, to give you an example, with the EU. Okay, if the EU sends a car to the United States, let's look at a BMW, a Mercedes, something coming out of Germany, we charge a 2.5% tariff on those vehicles entering the United States. If we send a car from the US to the EU, they charge a 10% rate. Okay. And the administration said, look, we can do this one of two ways. You can come down to meet us, right? You can charge 2.5%, just like we charge you 2.5%, or we can come up to you. We'd much rather you come here. What we'd love to see, and what I think, quite honestly, I think we will see, is movement on rates in this direction, moving towards freer trade in the long run. Now, a lot of these countries, they've had this benefit. You charge us less. We've still been able to generate revenues off you. We're still able to protect our industries, and you're not doing that so much in the United States. When they get pushed to say, look, play on an equal playing field, I do think you will see movements. But I also want to note, if we go back to Trump 1.0, okay, with Trump 1.0, where China was a heavy emphasis, but again, we had steel and aluminum, which have come up once again. What we saw in terms of actual economic activity after the tariffs were put in place was that activity did not decline after the tariffs. In fact, global trade, US engagement in global trade did not decline when we put the tariffs on China. The total volume of our imports and our exports rose. What we saw during that period was that with the uncertainty related to China, the potential for that to be a longer going conflict, companies said, well, I'm not sure I want to put a factory in China right now. Here's what we're going to do. Well, we're going to put that in Vietnam, or we're going to put that in Taiwan. Some of them went to Malaysia. Some of them ended up coming to Canada, to Mexico. Some of it even went to places like France. We moved where activity took place. But we didn't stop doing the activity. Now, some people have said, but if you put tariffs across the board, right, and even if some of them come and negotiate, you're still going to have more disruption this time than you did before, and that may be true. There are certain areas that they're looking to do more of that building, that infrastructure, to build it. They're looking to put power behind it. They're looking to protect it. If you think about things AI related, energy production related, some of the supply chains related to medical, going through COVID and going through a time period where we realized that there are certain key attributes that we don't have capacity that we're producing here right now. They are going to try to push to get some more of that brought back here to the United States, but that's going to take some time. In addition, I spend a lot of my time in the data. I write a lot of commentary. I do a lot of research. We do forecasting, but I spend a lot of the time. This is the first week this year I have not been traveling. I go out and I meet with financial advisors. I meet with small, mid-size, up to Fortune 500 companies. Recently, I've had a couple trips where I'm meeting with organizations, the National Society of Structural Engineers, the Steel Institute, the Copper Council. I wanted to get an idea from these organizations that deal with the producers, the buyers, the infrastructure around some of the most critically targeted areas of the economy under these tariffs. And I asked them, how much of an impact is this having on your business? And the general response that I got was, well, if we're the Steel Institute, if we're steel companies, or if we're structural engineers, we're not making decisions about building a factory based on where we think rates are going to be or where we think tariffs are going to be over the next 2, 3 years. This is a project with a 30, 40, 60-year lifetime. It hasn't really shifted things for us. And even if we were to put that into place, if they wanted to get more domestic steel production, they said our time to get that project online is probably going to be 4 years from the initial development, the planning, buying the land, putting together the factory, bringing in the machinery, training people, getting actual output. They said, if there are impacts from the tariffs that do lead to more direct domestic production, we need to be patient on that. It's going to take time. Now, that has brought with it this lag time of when tariffs may be impacting and there's maybe questions outstanding. I've heard a lot of discussion that is bringing up it's bringing up concerns from groups like the Federal Reserve that could be inflationary. And this is something again, I think you're going to hear a lot about this year. It's a topic that I've spent a lot of time thinking, and I want to explain to you how I think about inflation because we've been dealing with inflation over the recent years. The Fed missed the boat on whether or not we were going to have inflation. And I'll show you why I think they missed that, but I also want to show you why I don't believe that tariffs are going to be that inflationary. Now, here, in order to understand this, what I want you to do is come with me to an imaginary economic world, which I'm sure sounds like a thrilling place. Bear with me for a few minutes. In this imaginary economic world, there exists only two things. You've got $10 and you've got 10 apples. Okay, that's it. You've got the money that you can use to buy things, and the apples represent everything that you can buy. Now, if there's $10 and 10 apples in an economy, how much is an apple going to cost? You look at it and say, well, if there's all that money, well, it's gonna come out to about $1 per apple, right? The dollars chase the goods. That's how an economy functions. Now, I want to go look at the COVID time period to understand why we did see inflation there, because that was a period where many people did not expect. The Fed did not believe. They told us, hey, it's going to be transitory. We said it is not going to be transitory. And here was the difference in our thinking. We looked at it and said, you've got more money that came into the system, the PPP loans, direct stimulus checks, additional unemployment benefits. We had about 42% more money enter the system and go into the hands of consumers and businesses. And the Fed said, don't worry about that. Don't worry. Okay, that's not going to be inflationary. The issue is the supply chains. People were sent home. We couldn't operate. We couldn't be in person. And you started hearing about 111 ships waiting offshore, waiting to dock and unload at the port of Long Beach out in California. So get the supply chains back. That's your biggest issue. If you get the supply chains back, inflation will be transitory. And my first thought was, well, wait a second. Even if we never lost production, let's assume for a minute that the US never sent anyone home. Let's assume that no factory shut down. Let's assume that every product continued to run as it had run before in that type of environment. Oh, did it end the sharing? Carla, can you still see it? For all of a sudden, it changed something on my end. It looked like it took away the sharing. I just want to make sure you're able to see.
We cannot see. I think it jumped out. Are you able to
Let's
reconnect it?
see. It's saying that the sharing's not turned off. It's sent a request. So we'll see if that one comes through.
Okay.
I don't know if something else asked to share. While we try to figure that out, let me
Try,
walk through.
try one more time, Andrew.
Okay. Yeah, perfect. Let's see. There we go. We got it. Thank you. Okay. So when the Fed said, look, the issue is going to be the supply chains, I looked at this and said, well, if we never lost any production, assuming that the US economy was still producing at 100%, we were still getting 10 apples of output. If you have $13 and the supply chain is fully back, okay, what's going to happen to the price of an apple? Because you have more money, the price of an apple is going to go up. And the Fed said, okay, we get that, right? We hear what you're saying, but here's the problem is we're not at full capacity. And if we had $13 and five apples, inflation is going to be at 260 per apple. I'll do the math there for you. And they said, as we get one, two, three, four, as we get back to 100%, this is going to go down. That inflation is going to be transitory. It's only going to be temporary. And I think there was an issue here in terms of the communication. It was never that we were going to go from that high, really high potential inflation back to where we were when all this started. It was not that we were going to go back to the 2019 prices. It's that we were going to have to get to this new level. Inflation was going to enter the system. The money was going to feel the impact. This is why inflation was not transitory, in my opinion, why we did see inflation of 5, 6, 7, 8% as we ultimately went through that COVID time period. Now, I want to take this example, but I want to step it back and I want to understand how it impacts tariffs. Now that we have an understanding of, when things prices go up, right, or when supply chains go down, apples move, dollars move. I want to think about how that would impact our system right here. And in order to do that, I'm going to take this apple, that first apple in the chain, and we're going to call that a car. And this is a car that part of the production is done in Mexico, and it uses steel, it uses aluminum, so prices are going up because of the tariffs. Ford talked about this. You've seen industry groups talk about it. I'm going to tell you that this car is going to go up 15% in price. Okay, 15%. 15% in price. Okay. And that 15% increase, you're going to have to buy this car. Your car broke down today. You don't have a choice. I wish you did, but you can't repair your car. You can't find a used car. That's the type of thing people would normally do is hold on to a car longer, maybe repair it, look for a used vehicle. I'm going to tell you, you have zero option here to do anything but buy this car. And now turn on the TV and they say car prices are up 15%, tariffs therefore are inflationary. But I want you to pause for a moment and I want you to think about this. If the car price goes up 15%, yes, the price there is higher. Did your income go up 15% because the car costs more? I think the answer to that is no. We don't tend to see massive jumps in income when tariffs get put in place. Otherwise, people would probably be less concerned about tariffs. But if the income, the money in the system doesn't change and that apple goes up 15%, if you're not making more money but you have to spend more on the car, what does that mean for the other categories of your spending, everything else that you buy? And what it means is that you're going to have to make some decisions now. If you have to buy that apple, maybe this apple, which we'll say is eating out, maybe you eat out a little less. Maybe you go on and travel, do a little bit less vacation. What we've seen historically, and I've run through multiple iterations of this, there is really under every president that we have had in the last 70 years, there has been at least some work on tariffs, some implementation, sometimes bigger, sometimes smaller, sometimes broad based. Nixon did that in 1971, where he put a 10% tariff across the board. And I went and I looked back and I said, how impactful is this? And what it showed is that when the prices rise in a category, it can be inflationary in a category, but the movements in these other categories essentially fully offset. And I want to give you one example, right? If you go back and think about what commodity, what's something that you use every day? And I know you're using it right now because you're looking at a screen and that screen needs power. If you have put gas in your car, if you've traveled in your car, if you have heat on in your home, energy is a critical piece of US infrastructure. And oil tends to be a major part of that energy infrastructure. There have been a number of times where we've seen wild swings in energy prices. They go down 30, 40, 50%. They go up 200, 300%. So what I wanted to do is go look at some time periods where we saw those major shifts and ask, did it create inflation? Over the last 10, 15, 20 years, we have seen at least two time periods where energy prices fell by at least 70%. Okay. And then ultimately rose again by 200, 300% just to get back to where they were. One of those was here during COVID, right? And so there was this period when everything shut down. We didn't see deflation, but energy prices actually went negative in here. I would argue it wasn't the energy prices coming back up that led to the inflation here. It's the fact that there was so much money in the system. But the other one was right in here. 2014 to 2016, Saudi Arabia came in, dumped energy onto the US markets, trying to push the frackers out because they were infringing, they were gaining power internationally. And in that type of environment, it meant that we didn't have to spend as much on our cars. We didn't have to spend as much to heat the homes. But from an inflationary impact, just as when prices go up in a category, we offset by cutting in other areas, when we didn't have to pay as much to fill the car, we ate out more, we traveled more, we spent a little bit more on leisure. And what we see historically is yes, money makes a big difference, but times like tariffs or times like shifts in major components tend to be less inflationary than we think. Now, a group that has to deal with this, and I was taking a quick look at the release they put out today, and they're going to hold a press conference here shortly to talk about what they're thinking. The Federal Reserve has said, well, we are concerned. We are thinking about uh, what we need to do. Now, let me just note here at the end of this chart, there is inflation and the way inflation has moved here over recent months, essentially flat. After, rising and then coming down, it's moved essentially sideways. And in this environment, right, during this time period where it moved sideways, they cut first by 0.5%, and then they did two more cuts of 0.25% for a total of 1% cut in interest rates in 2024. There's been this question of why were they cutting, particularly those last two cuts, if inflation had stalled out. Here's their 2% target. We're clearly notably above that. Why is it that they continue to cut at the end of last year if inflation was a problem? Why don't they just keep rates high until we get things down and we make sure that inflation's under control? Let's not repeat any issues. Let's not repeat any decisions that we made in the 1970s that led to a recurrence of inflation. Well, the reason that they wanted to start, the reason that they felt it was appropriate to start, was because they have a dual mandate. There are two things they're tasked with: inflation, yes, and that's been a primary over the last 2, 3, 4 years, but also employment. And employment has started to show some things that they are less excited to see. One of those, right? You look at this chart, this is getting the jobs back. We remember March and April of 2020 when we weren't sure if we were allowed to go to the grocery store. We weren't sure if the coffee shops were going to be open. This is when we, lived through the great toilet paper run of 2020. After that tremendous downturn, we started getting back to business. And we noticed we're back up. We hit that milestone where we had everybody, at least the same number of people working as before. And now we're net up. We have more people working today than we've ever had in US history. And the Fed, you could look at this and say, well, the pace of growth now today also looks similar to what we were seeing pre-COVID. Why would the Fed be worried about employment? Again, why did they start these cuts? Well, it's because the employment growth here looks very different than the employment growth here, more broadly, the employment growth that we had during the prior recovery. There are certain sectors that have been dominating. Sectors that don't historically dominate. In fact, there's two sectors over the last 12, 18 months that have accounted for 60% plus of the job gains over here. And during this time period, they were closer to 12 to 15%. Who is it that's running very hot from an employment standpoint, driving growth, and maybe has things questioning the sustainability of it? Well, the two sectors that are dominating are government and healthcare. Government has been the number one hirer. Now, I'm not saying I'm against government hiring. My wife is a public school teacher. I do think there's some important roles in there, but when you see periods like this, where there's a 12 to 18 month stretch where for not a single month the entire rest of the economy was keeping pace with government and healthcare. And you notice there's multiple months in here where there was outright declines in the entire rest of the economy. The overall number looked like it was sustaining at a relatively healthy pace, but as soon as you dive beneath the details, you realized this isn't sustainable, and particularly from a market standpoint. Government is not typically a big driver of S&P 500 earnings. It's not typically a major driver of GDP growth. Healthcare does have some components of it. Unfortunately, a lot of the healthcare employment that came here over the last 2 years has come from government-run programs. One most notably from New York, where it's good intentions. New York had an issue with not having enough elderly care. And they said, we don't have these social work assistants. We need people to help take care of them. And what we're going to do is we're going to allow people, family members, to help take care of family members. Nana, Papa, your mom, your dad, if they're elderly and they need help, go and be that care. And so they said, we'll pay you $30 to $31 an hour to do this care. And they started this program. They started to see the hiring, the numbers running up. Healthcare became a major job area within the state of New York. And about a year and a half in, they started looking at the numbers and they said, uh-oh, something here did not turn out like we expected. What they found is that the system was wrought with fraud. I didn't see that one coming either. When you offered people $30 to $31 an hour to self-report that they were doing something, and you didn't really have much check or validation on it, it created an environment where the government in that state was paying out a lot of money for what had appeared to be jobs, but you weren't seeing any improvement in health outcomes. And this isn't going to sustain. And now you obviously see what's going on TV, whether it's Doge or even on the local, state, and local level. Government is saying maybe we need to pause and think about this. If we see these areas pull back, now the question is, do we have the strength from the entire rest of the economy? Does Main Street, do mom and pop, do they have the strength to push us forward? And we've started to see some slight improvements in the data as of yet late. We hope that that continues, but the Fed realizes if they cut interest rates, small and mid-sized businesses are very interest rate sensitive. If inflation is moderating, even if it's not down, they said, well, let's start that process. Let's try to get these numbers here in all these situations. Let's get back to positive in order to see sustained economic growth. Then they hit the end of the year and beginning of this year, right? And they again have had to face the inflation question. They thought maybe when it moved sideways for a month or two or three that things would turn the corner. It's continued to see inflation moving sideways far longer than what they thought. And here we deal with something that in the best of terms, I can only say is really confusing. To understand one of the major issues we have with inflation today, here's what I want you to do. I want you to assume for the next 2 to 3 minutes that you own a manufacturing company. Okay, you can pick your industry. You could do steel or you could build homes, whatever you want this to be. You do some sort of manufacturing, production, goods-based business. And I am going to be a group called the Institute for Supply Chain Manufacturing. I am a group that goes out and talks to you. Every month, I ask you a few simple questions. Are your orders up or down? Is your production up or down? Are your order backlogs up or down? Is your employment up or down? And how about prices? Are those up or down? Right? Pretty relatively easy questions. I just want to gauge, are you growing? Are you declining? Are prices becoming a bigger issue or a smaller issue? Now, here's what I'm going to tell you is that you and your friends, the other people in your industry, have told me now that for 23 of the last 25 months, orders are down, production's down, work through order backlogs, not hiring, not firing, and prices are still a problem. And I want to ask you this question. If you own a company, you're the CEO, you started this thing, you founded this thing, you put your blood, sweat, and tears into it, and for 23 of the last 25 months, orders are down, production's down, you've worked through the backlogs that have built up, are you thinking to yourself that, A, this seems like a great time to build a factory? I should bring out a new product line. I should expand, right? This seems like a really good opportunity. Or are you thinking to yourself, B, this is tough. Maybe we overhired a little bit. Maybe people jumped the gun when we had COVID and we thought maybe this surge that we had in goods demand was going to continue on for a prolonged period of time. And now that it's cooled off and now people are getting back outside instead of buying things to bring home, maybe we need to pull back. Maybe we need to calm things down. Let's use what we have. Let's use who we have and let's get through this. Your CFO, your chief financial officer, is probably saying, hey, take route B there, right? You, as the owner of that company, a lot of those companies, you would expect them to say, yeah, I think that's what I'm going to do. I'm going to take it easy. Demand will come back, but I'm going to wait for a little while. And then we have to reconcile that with this. Over that same time period, that the company said orders down, production down, work through backlogs, right? We're in a recession. They've seen a tripling in construction spend. And this is the largest increase we've seen over a 2, 3 year time period, basically ever, on the manufacturing side of the economy, both in dollars wise and percentage wise. This is one of the biggest booms we've ever seen. So now ask yourself, if orders are down, production is down, why? Why would this be happening? And let me just note here too that before the construction started, interest rates were at some of the lowest levels that we've seen in decades. As this has been going on, interest rates have risen massively. which means that as companies have started these new projects and they're running at higher levels today than they were a year ago and 2 years ago, if they're borrowing to do that, they're paying at higher rates. So why? Historically, when it's more expensive to borrow and buy a house, people don't buy more homes. When it's more expensive to borrow and buy a car, people don't buy more cars. They buy less. So what's going on? Well, I was sitting down with a recently retired Fortune 500 company, and I said, how do you explain this? He said, well, Andrew, it's actually pretty easy. Think about we had things like the Inflation Reduction Act, and we had the CHIPS Act. And so his company, which was on the good side, he said, we had the government come and say, we're running these programs. We understand that your orders might be flat to down, that you guys might be having a tough time, but we want to bring some supply chains back to the United States. We're going to focus on some infrastructure projects. We'll pay for 20 to 40% of your build. We'll give you a grant to do that. We will subsidize the loan to make sure that the interest rate is not inordinately high. We'll help to make sure this happens. We understand you don't have the demand right now, but by the time the factory's built, 3, 4, 5 years from now and is in operation, you hopefully the demand is there and you're ready to go. Now, if you are the CEO of a company and the government says, I want to pay for 40% of it, are you going to say, hey, thank you for that offer. We don't have demand now. I think demand will be back in 2 or 3 years. And when it's back in 2 or 3 years, I'll just pay the 100% of the cost because you're not going to offer me this deal anymore. Or do you say, you know what? If you're going to pay that amount and I'm going to have this plant, this facility for 20, 40, 60 years, we can start it early. We can start it even if the demand's not there because over the lifetime of this project, this makes business sense for me. The taxpayers are the ones that are paying for it, but it makes business sense for me. And that is essentially what happened. And we saw this demand. We saw these goods companies too say, hey, we're going to build, we're going to put things in. Maybe we don't have the demand right now, but by the time these are online, hopefully this leads to a pickup in production. The other thing this did is it tied up the workers, those workers that moved from the service side down to the goods side when we had the supply chain issues and we started to move it. As services has boomed and goods have held back, the goods companies are not letting go of their workers. So what we had was, here again is inflation moving sideways. We did have issues on the goods side early, and some of that was supply chain oriented. But the way we went about trying to fix it, we didn't drive prices back down to where they were. We drove the inflation problem over to the service side of the economy. And this is the difficulty. I don't envy the Fed chair, Jerome Powell. I don't envy. I would never want to be president. I don't envy some of the difficulty in decisions. In politics, you're relying, you want people to vote for you, you want people to like you. It's difficult when you go into a crisis, right? The easy thing to do is to say, let's throw money at the problem. The easy thing to do when there is unknown is choose the safe route, right? And say, maybe we're going to overdo it, but I'd rather overdo it than underdo it. And we got stimulus, the acts and everything. It was like economic morphine we got through the COVID time period. Now we're easing off of that. And we're seeing some of those issues. We're realizing some of the misallocation of resources. We're realizing, some of the mistakes that were made. So from a volatility standpoint, that's what we're facing at the beginning of this year. And as they try to cut back on some of the government spending, because we've run $1.7 trillion deficits each of the last 2 years, we've run higher deficits as a percent of the economy in each of the last 2 years with 4% unemployment than we did during the Korean War or during the Vietnam War when we were engaged in active battle. That's not a sustainable financial path for the United States. So as we're going through a bit of this reset, right, I think you are going to hear some inflation concerns remain throughout this year because it's not an overnight fix. I do think that as we go through tariffs, the uncertainty, not the actual activity, but the uncertainty, we don't like uncertainty as human beings. That might bring some volatility with it. And we also still have to deal with some of the geopolitical concerns. We are, you might have seen the data recently, Israel and Palestine. That looks like we may be seeing some re-escalation. That has had impacts. So has Russia, Ukraine. It has had some impacts. Israel, Palestine was really an interesting one for me because that deals with Hamas was firing on ships in the Red Sea as the conflict was rising, and the Red Sea is the major entry point to the Suez Canal. So that was boosting every time there was a rise in conflicts. Global freight rates, because of a rerouting, you could no longer take arguably the single most important trade route in the world. Companies, instead of going through the Suez Canal, were forced to go down below Africa via the Cape of Good Hope to get goods into Europe. And that was diverting ships from the US. It was diverting ships from Asia. Now, the good news is the goods still got there eventually. It took 4 extra days and about $1 million each direction in additional fuel costs. These are those types of things that are the unknowns, the variables that can continue to bring volatility in this year. But I want to end with is to take a step back. I was sitting there the other day and thinking about the technology we use, the fact that we can have these types of meetings. That I was watching my kids. I've got a 10-year-old and a 7-year-old, and their capacity with computers today, with devices, and they don't use a lot of it, but their ability to understand and use them is kind of incredible. And then I was sitting down with my wife's great grandfather, who just turned 100 years old in October of last year, and we were talking about how the world today looks nothing like the world that he grew up in. And he's like, it's incredible, Andrew. He's like, I could never imagine what my kids would see, much less my grandkids and now my great grandkids. And he said, he grew up born in 1924. He grew up in the Great Depression. He fought in World War II. He fought in the Korean War. His kids fought in the Vietnam War. He went through the 70s with the inflation, the race riots, the high interest rates of the 1980s, market crashes. He went through the dot-com bubble. He went through 9/11. He went through the financial crisis. He went through COVID. He's seen the Berlin Wall fall down and China open up. And he's like, Andrew, with everything that I've seen, experienced in my life, the best piece of advice I can give people? And I'm like, lay it on me, Grandpa Doll. He said, turn off the TV. He said, yeah, if you turn on the TV, you're going to be constantly inundated by things to worry about. But he said, the most incredible thing I've seen during my life, and he pointed me to this chart. He said, Andrew, when I was about your age, okay, I'm about 40 years old. He said, when I was your age, it was the first time ever in human history that half of the world's adult population was literate. First time ever that we exceeded 50%. And I paused and thought about that, and I'm like, wow, I think I take it for granted today that now wherever I travel, wherever I go, in so many places in the world, education is starting to catch up, and we're seeing this progress. We're seeing the access to information at levels we've never seen before. And he said, look at this chart and then look at this one. Do you think it's a coincidence that as we've learned how to learn, as we've improved sanitation, as we've improved education, as we've improved access to nutrition, he's like, do you think that as we've unleashed human potential, is it any surprise that this is moving in this direction? I said, well, when you put it that way, no, it's not a surprise. And then we started looking at this time period here, the last 20 years. He's like, you need to understand how big this impact is. So I started diving into the numbers. I said, okay, let's look at the numbers. This is data from the World Bank. They define extreme poverty as the number of people living on $1.90 per day. Go back to 2003, 20 years before the latest data we got, 1.6 billion people on this planet living in extreme poverty. Like, holy cow, that's a huge number, and that's a major thing for the world to be working on to try to boost prosperity, boost wealth, boost the quality of life. And now I looked at the latest numbers, 2023, last full year we have 714 million. Now, is that 714 million too many? Yes. But pause and think about that. That means that over this 20-year time period, we saw a 907 million person reduction in people living in extreme poverty. And I want to take it one step further. That's 7,305 days. That means we averaged over 20 years, we averaged close to 125,000 people per day moving out of extreme poverty for 20 years, day after day, week after week, month after month, year after year, every day. Over 120,000 people on average moving out of extreme poverty. And then it brought me back to this chart, and he said, look, Andrew, as people are improving, as the world has been advancing, and people are moving out of poverty, he said, I know we've got an immigration problem. It's all over the news, and it was political and all that kind of stuff. He's like, who doesn't have an immigration problem? Cuba. Who doesn't have an immigration problem? China. Who doesn't have an immigration problem? Russia. People are not clamoring to get into what they have. People are not willing to put lives at risk, to go away from families, to leave their world behind and take a chance in order that their kids may have a better chance. They're not doing that virtually anywhere else in the world at the magnitude of what we do here. But as the world is progressing, they want what we have. We are incredibly blessed in the world that we live in, but we're also central. We are critical to the next phase of what is taking place. We are the tech leaders in the world. We are the financial leaders in the world. And while I look out here and I look at 2025, again, some volatility. We were expecting to see a bit of a market pullback. I wasn't going to get out of stocks. I still think over the next 3, 5, 10 years, they're going to have a great run because these things trump to use the phrase, right? They're more dominant over time than the short-term inflation concerns. We've grown through inflation, we've grown through recessions, we've grown through Republicans, Democrats, full sweeps, split houses. I mean, the power of human potential is an absolutely incredible thing, and we are unleashing it again, as I said, today in a way that the world has never seen. It's an incredible time to be alive. And if we stop and pause and reflect and appreciate what's taking place, and we understand it, I think it helps us to cut through some of the noise that brings the fear day to day. This is what we look at. We watch these trends. We talk with Carla and the team, right? And we try to understand the big picture. We try to look at the data and not get caught up so many times into the TV's saying this and CNN said that and Fox said this and this person yelled at the other person. We think data is critically important. And hopefully getting a chance to look at some of this data today, hopefully this gave you kind of an idea of what we're seeing, kind of the way that the world is progressing, what you may hear about as we move later through this year. I want to congratulate you. You just listened to an economist talk for close to 40 minutes. Back in school, that would put some people to sleep. But thank you for giving me some time, Carla. Thank you for having me on with that. Why don't I pass it back to you?
Thanks, Andrew. You have given us a tremendous amount of information and the reporting that you give. We greatly appreciate that. The documentation and so forth. So with that, Andrew, can we ask questions?
Yep.
So what I would ask you to do is please go into the chat and type your question for Andrew, and then I'll read it and then he can respond. I do have a couple questions that I can get us started with. A
Okay.
lot of clients hear, so they're hearing this on the media, right? They're
Yeah.
hearing a lot about Social Security lately. It's
Hmm.
going to be there. They're hearing the concerns. I get probably calls weekly on whether Social Security is going to be there. So if you can cut through all the media discussion on that and let us know what your thoughts are on that, Andrew.
Yeah, I mean it is a major topic. It is a major discussion. But as it currently stands, as it's currently formatted with the spending that's been going on, the aging demographic, the way that we have it, Social Security is set to be able to fund itself for about the next 10 years, after which it cannot be fully funded. Now, the problem is that if you break down, if you go look at when Social Security was created, we really haven't changed the infrastructure surrounding it very much since it was created. When it was formed, the average individual receiving Social Security was expected to receive it for 2 to 3 years. That was the expected remaining lifetime once you hit the age where you could get Social Security. So today, that number is closer to 20 to 22 years. We haven't really changed the pay-ins, but the expected output from it has changed. The other thing that I think not maybe people don't really realize is that when the money goes into Social Security, it really only gets invested in one thing. This is how it was structured. They set it up. It basically only gets invested in U.S. Treasury securities, bonds from the United States. It doesn't get invested in the market. If instead of treasuries, it had been invested in the market. The balance on Social Security today would be closer to 15 trillion. The number, it would be very well funded, but they moved it and they said treasuries. It's treasuries, it's safe, it's the US debt. We can always tax if we need to do that. But then when we pushed interest rates to near zero around the financial crisis and we held it there for close to a decade and we did it again during COVID, we were trying to make it easier for individuals. We're trying to make it easier for companies to be able to afford this. But the other thing we did is we just demolished the returns on this money that was being set aside. It wasn't keeping pace with inflation. So if I had to look forward, somebody said, Andrew, you got to, look into a crystal ball. Is Social Security going to be there in 10 years and 20 years? The answer is yes. I do think it's going to be there in 10 years and 20 years. Do I think it's in the exact same form that it's in today? Yes, for those that are receiving it. No, for those that are still at least 10 years off. I think what you're going to see is an extension, a pushback in the retirement age, right? But I think there's also going to have to be some discussions on the pay in versus pay out and whether there is a shift in terms of how some of that money gets invested when it's in there. What the politicians like to do is say, well, let's fix it for the next generation. And the way they define the next generation essentially is if we're going to make a change that some people might not like, let's have it go into effect for people who are not yet of voting age, right? So they're like, oh, anybody born, let's see, today's, it's 2025. Maybe we set it as 2010. Anybody born after 2010, you're going to have different criteria. Because if you're born after 2010, you are not at voting age yet. You can't push back on that. So the current politicians are like, this is how we'll pass it through. We'll get it. That will help the system eventually. Faster economic growth will help the system eventually. But this is a topic I think you're going to hear a lot of focus and discussion in the back half of this administration. Not this year, probably not a lot next year, maybe a little bit. But I think this is going to become more of a focus as we get to the back half of this. I think the Democrats are going to take the House. I think the Republicans are going to keep the Senate in the 2026 midterms. And after that, with a split House and Senate, all the focus I think is going to move towards entitlements. And for the next administration, it's going to become a critical time because as we lose that leeway, we lose the time we have before we hit that roadblock. It's going to be more and more pressure on Washington to do something, and I think they will, but they don't tend to act until the pressure's really there.
Okay. Thanks, Andrew. So you're very good. So what would you recommend people do because they're hearing this in the news, right?
Yeah, I mean, I think having a plan with a financial advisor, having a plan beyond Social Security to be thinking about how are you retiring, how are you, Social Security may be a portion of it, but having the structure. I mean, this is if somebody started off when I have a college intern come in, or I talk to my kids, or I talk to a high schooler who's thinking about college. One of the first things I tell them is start put the money away early, right? And leave it in the system. You're going to turn off the TV, right? Just leave it. You've got this time horizon. If you build up that wealth, then what happens with Social Security? It's going to have some impact on you, but it's not going to break your scenario. It's having that money that's set aside and having a process, having somebody. Because the people that go and try to do this thing on their own, I always tell them, go find a financial advisor. Go to someone who you can set up a plan, you can trust in the plan. So when the world gets wacky or when the market takes the downturn and you think to yourself, oh, everybody's getting out of the market, I should get out too. You've got somebody there who can say, hey, right, I understand the emotion, I understand that concern, but here's why we stay invested. Here's why we do this over time, because I know you can't time the market. I know I can't time the market, but time in the market has been our greatest friend and emotion has been our greatest enemy. I always tell people if financial advisor is the number one thing. You need to have that in your plan. For people that are later in the game, right? It doesn't matter how close you are to Social Security or even if you're in it, still have that conversation to figure out what you can do from here moving forward and to help set up the next generation if you've got kids or grandkids or anything like that. That to me is what's so critical to do here. The less reliance we have on government making the right decision, the more that we've protected ourselves through our actions, I think the more comfort you can have knowing that you're going to get to that goal at the end of the day.
So we are financial advisors, right? But we are
Mhm.
also counselors.
Yeah. Oh, yeah.
So we do help people through that process, but you're absolutely right. The financial advisor is an important role in helping people to achieve their financial goals
Yeah.
and and push through some of the fear that's out there. There's a lot of fear. Media is good at fear. That's what sells.
Yes.
So we have to understand that. We listen to Grandpa. What's his name?
Yeah.
Grandpa? Grandpa? The 100-year-old grandpa out there. He
Yeah.
knows. And so do you have anything on your radar that you're looking at this year that could cause like a major black swan event? You're looking at this, you're looking at that,
Yeah.
that could turn these markets a different direction.
Yeah. I mean, one thing that's out there that's on the radar, but I think is a low probability, if China invades Taiwan. China's in an interesting spot. They've had a declining population now for the last 2 years. China's going to have a declining population for probably at least the next 2 decades. And so I think they're kind of looking and saying, we believe that Taiwan is our territory. Taiwan believes they're independent. We need them independent. They are the producers of the top end chips. About 85% of the top chips that are being produced for high end technology today are coming out of Taiwan. If China were to say, this is our chance, we're not going to get stronger from here, we're going to weaken from here, let's go ahead and put troops on there, let's take this back under control, and that started a war, Taiwan being shut down would have a tremendous impact. That would throw many global economies into a recession, short to intermediate lived, right? And we would ultimately restructure and we'd come out and we'd grow from there. But that's a black swan event that I look at and I say it's unlikely, but we always have to keep it on the radar. We always have to keep watching it. Beyond that, there is the risk if tariffs all of a sudden all the countries were just to escalate, and everybody were to push away from each other, then that would have impacts from a both from a domestic and from a global standpoint. But I always look at these situations and I ask, what's the incentive? What is the gain if you were to follow that action? It doesn't mean that people don't act irrationally, but countries, particularly globally, when push comes to shove, what we've seen is that companies say, okay, maybe I'm upset that Canada's upset that the US is putting the things on. But at the end of the day, they could say either we fight back and we just say, we're going to move away from you and we're going to lose our biggest trading partner and one of the greatest sources of purchasers for us. Or they say, okay, you're upset, I'm upset, but we need to cool our tempers. What can we do to work together? What can we do because we benefit each other over the long run? And this escalation, the escalate to negotiate, I'd rather we just get straight to the negotiations. If emotions win the day, then we could have more disruption in the short term, immediate term. If logic and if the voters push and say, look, do what's right, then I think we see progress. But we always have to watch for it. It's possible something happens, unlikely but possible.
Okay, very good. And then another question I have is commercial property.
Hmm.
So I've read some articles about commercial property that there's some concern that if they can't continue to pay their loans, right? You've
Yep.
got banks that hold those notes. And
Yep.
so could that decline
Could there
there?
be some knock-on effects? So
Yep.
within commercial real estate, it's kind of bifurcated. Within commercial real estate, you have things like data centers, and those are doing just fine. You've got a lot of the warehousing. Warehousing is slowing down. There was kind of an overbuild during the COVID time period, but they've been using that space. Essentially, the big companies have been absorbing that excess stock and not building as much. But there are areas like office real estate. I mean, one of the pieces that I look at on office real estate is there's a company called Castle. Castle does the swipe cards that a lot of companies use for access to the building. It's like the name in access cards. And Castle then tracks, how many swipes are we getting today versus 2019? And even today, we're at about 50 to 60% return to office, which means there is still about half the people not working from particularly major downtown locations. And so you've got empty office space, you've got companies that had too much space, some companies are giving that back, and you've got buildings that companies have borrowed, they bought, they built, they own that are no longer producing. And that has brought some concerns. Are they going to get written down? Again, I'm just outside Chicago. There's big buildings in Chicago where the loan hit, people couldn't pay it, and it got sold at auction, and it got sold for about 40 cents on the dollar. Somebody took a hit on that. Investors took a hit on that. Did banks take a hit? Some took a little bit. Now, here's the thing with commercial real estate. The commercial real estate holdings that are held by banks are almost entirely held by local and regional banks. The big banks, if you think JP Morgan, Bank of America, Wells Fargo, Citibank, what are called the GSIBs, the globally systemically important banks, the ones that the Fed worries if something happened to them, the system falls down, they hold very, very little. And what they do tends to be what's called grade A multifamily. It's like the prime apartment type housing that has very little issue. So what I'd watch for is if you start seeing certain towns or certain areas, certain cities having difficulty with filling the buildings. Some of the regional banks will have issues, and you have the big banks, and you've got the Fed there saying, we're here to help. We've got facilities. We can look to do this. But there is certainly a portion of this where it was complete. Nobody in 2018 was saying, hey, better be careful if you build that new building because in 2 years that pandemic's going to come and you guys might not use that space. It wasn't that people made a stupid decision to build it. Some of that will get moved into real estate. Some of that will get repurposed for other things. But most of it, at least from what I've seen, it's mostly been private investors that have kind of taken some of the losses on that. Small and regional banks, you may hear a little bit about it, but they've been working to protect that because this has been on the radar now for about 2, 3 years.
Okay. So one other question. Thank
Yeah.
you, Andrew. Uh, so back in 2022, I read a report that stated we were supposed to go into a recession in 2022, right?
Mm-hmm. Mm-hmm.
Positioned. So what pulled us out is all the immigration. So we had 14 trillion, not trillion, 14
Yeah.
million, million trillion, what's a couple of zeros, right? Um, so 14 million immigrants coming into the country. We're designed to have about 1 million immigrants come into our country per year, right? That we can handle. But when you have 14 million, that really significantly changes the
The
dynamics in our
dynamics,
country,
right?
right?
Right.
So if a lot of these immigrants are leaving, I'm not sure, what your statistics show there,
Yeah.
but will that impact our future?
Yeah. And it's interesting to note, I'll go back. Well, I don't have the slides up right now. if you look at the net increase that we've seen in employment, because we are net up, 6, 7, 8 million workers versus where we were pre-COVID, a non-trivial portion of that, somewhere in the region of half of that, it's estimated, has come from immigration. And now there's been this question of if we were to see heavy crackdown on immigration and we were to see deportations, is that going to really impact industry? And there's two kind of sides to this. One is the question of when you have people coming into the country, immigration, it does increase production. It also increases consumption, right? People come in and they're working, and that adds to the jobs, it adds to the workforce that's there. But they also need housing, they need food. There's a number of things that go with that. As you see a move away on the immigration side. Let's say we saw a net migration out of the United States from a prices standpoint and inflation. People say, oh, you're going to see wages go up and you're going to see all these issues showing up in industry. It doesn't impact quite as deeply as you'd think, right? Logically, it says, yeah, that would have a tremendous impact. People go, they leave the country. You're going to see this rise in wages, demand for workers, but it also gets offset in part because the demand leaves with it. But um, the more important thing here is look at the actual numbers. I started looking at the deportations. I constantly watch the numbers of the number of people that come into the United States, particularly working age population. That number, if you were to go back to the Obama administration, we averaged about 800,000 working age population joining the labor force every year. During Trump 1.0, that was 400,000. During the Biden years, it was 1.4 million. During this administration, it's still expected to be positive. Net migration is expected to be positive. You heard about deportations. They put it on the TV. The first day after the election, they show them lining people up, putting them on a flight to send them out of the country. The number they're targeting is 1,000 to 1,500 deportations per day. Okay. The number they said was 12 to 18 million people would get deported. If you stop and you run the math on that and say, okay, if we did 1,500 people per day, 365 days per year, to hit their target, it would only take, I believe, about 38 years. And so you're like, wait a second, that this is a 4-year term. You can't get that far. There's the numbers that get thrown out, and then there's the actual activity that's taking place. They're cracking down in certain areas. They're looking at people, again, the criminal record, which this isn't new. We've done this under prior administrations, even on Democratic and Republican. It's been on both sides. The Clinton administration looked to do something. This is actually something that Hillary Clinton had run on. She said she wanted to do the same thing with if you were here and there was a criminal record, or if you got caught for a non-immigration crime, we would look at deportations. So a lot of rhetoric because again the TV knows how to play on emotions. They know what's going to get people riled up. They know what's going to drive people to get upset. But from an economic standpoint, from an inflation standpoint, we always have to take that step back. We always have to look at how much does it really impact. And the reality of that situation is it's pretty minimal. What we're seeing reduction, particularly on the southern border, in terms of the immigration. It's freeing up capacity then to get used for immigration from places like Europe. We paused immigration in a lot of those places because we were overwhelmed by the amount that was coming from refugee stuff towards the south. So again, I think we'll see net immigration taking place. I think what you'll ultimately see is that it'll show more high skill immigration. They're going to focus more on production ready or able to contribute faster. Immigration needs to get fixed. I believe that immigration here in the United States needs to get fixed. I personally believe in, high walls but wide entry gates. If you want to be here, I want you here. If you want to contribute, I want you to contribute. My relatives, my ancestors came over here from Europe, right? Everybody that's here is an immigrant at the end of the day, but we have to get the structure so that we can bring you in, get you a place, get you assimilated, get you set up to succeed here. We need to get that infrastructure, and that relies on Washington, really putting in some legwork that they haven't shown they're willing to do. So you'll hear about it. It'll continue to be an issue. It'll continue to be a hot button topic. But from an economic standpoint, it's not going to be, I don't believe, very impactful in terms of how much we grow and truthfully, how much movement we see in the employment market.
Okay. One last question Carla has.
Okay.
Uh, so what is your outlook, First Trust outlook or Brian Westbury's outlook for this year, the
Yeah.
markets?
Yeah. So let me just kind of run down the list. So GDP, the national output of the US economy. I do think we could see that dreaded R word, the recession word, show up as we're doing some of this reset. I don't think it's a deep recession. If we do see it, I would look at it as like a 90-91. It's a 1 or 2 quarter where we go negative by about a 0.5%, and then we've kind of done some resetting and we're back off to growth. On the inflation side, last year we ended with inflation, headline inflation around 3%, core, which excludes food and energy, which is volatile components. That was closer to 3.5. Quite honestly, I think inflation is going to move largely sideways this year. I think we're still going to be in those similar ranges. I think the Fed is going to look to cut. I think they're going to try to cut 2 times by the end of the year. That's what they actually signaled again today. They're concerned about that employment. If employment weakens, I think the unemployment rate is going to end this year just a little bit higher than where it is today. Not a notable decline, but a little bit higher than where we're at. I think the employment growth, which has been running 150, 160,000 jobs per month, will probably get down to that 120 to 140 range, a little bit slower, but still positive. If we see weakening beyond that, again, we see an escalation with trade wars, we see some other black swan event. I think the risk is that the Fed cuts too much in order to fight the employment side, that inflation moves higher. On the market side, we expected the market to be down a little bit this year. In the last 2 years, earnings rose 5.6% or 5.8%. The market rose 58%. We saw heavy concentration in the Magnificent Seven names, a couple high flyers that really pushed the market higher. And what we're seeing this year is a little bit of that reversing. People are saying math is important. Maybe we got a little ahead of ourselves on valuations. Maybe we were pricing things to perfection. But again, it's one of those things where I look and say, we're doing this reset process right now, which quite frankly is a healthy process. As we make it through this year, I'm not making substantial changes. Whether I'm a company or whether I'm thinking about investments, I'm not saying this is a full reset. I'm not This is not '08. This is not, 2020. This is not the dot-com type thing. This is an environment where we're getting those feet underneath us and saying we went through a weird period over the last 4 or 5 years, tremendous government spending, a lot of economic stimulus, but we need sustainability. So let's figure out where we're at. Let's figure out what's needed. Let's talk internationally. Let's get these trade things down. Let's get that buttoned up. We'll get tax cuts later this year, or at least the extension of the tax cuts that were in place. We'll probably get some deregulation. And as we look to 26, 27, I think that's when you see that traction starting to take in, and you'll see growth reaccelerate. That's what I'm looking at. That's what we're looking at right now.
Okay, so kind of a mini reset is what you're looking at. We need to
Yes. Yeah.
reset a lot of things with the government and
Hmm.
business, manufacturing, all that type of thing.
Yeah.
And what do you think about Social Security? Trump had made a comment about not taxing Social Security on. Do you think that's coming?
Yeah, they've said they're not going to do much movement on it. I think Social Security is something that is going to get talked about, second half of the administration. Sometimes he says things against a 72-hour rule. He'll say it. Let's see what he says in 72 hours. If they do anything on it in 72, he likes to throw out ideas, get media attention. And then the people that are behind him, that are the policy people, are like, hold on a second. We're going to have to actually figure this thing out. So I, unless they can pull back spending significantly, if they're doing the tax cuts, and they really want to move the corporate tax rate lower, which is what they've said. They want to move from 21 down to 15 or 18. They're going to have very limited capacity to move in some of these other areas. I would be a bit surprised if he said we're going to fully untax that, but time will tell.
We appreciate your time, Andrew, and your expertise. Thank you
Thank
so
you.
much.
Thanks for having me.
And I think we're all set. I don't think we have any other questions here. So thank you so much, Andrew. Have a wonderful day. Everybody have a wonderful day.
Yeah. Take care.
Bye-bye.